This is Cece. Welcome to the Orbit. It is Wednesday, February 14th. We've got futures higher this morning. This follows a sell-off in the market yesterday following a hotter than expected CPI and a bit of a narrative change in the market as yields spiked a little bit, treasury yields spiked a little bit, and the assumption of a Fed rate cut got pushed out even further. There was talk towards the beginning of the year about a potential March rate cut. Then that got shifted over the last month, let's say, to May. And now it's sort of up in the air and it will await more inflation data. So, right now, that's what the negative reaction in the market was. You saw it particularly in interest rate sensitive names like IWM was down about 5% at one point yesterday. So it was a bit of a bloodbath, and I think 98% of the stocks on the New York Stock Exchange were down yesterday. So a pretty severe sell-off. And then towards the end of the day, we saw a bit of a rally. Let's come in here on the 1 week chart. We rallied into the close, and that is basically 1% rally into the close. And then this morning we are following that with almost a 0.5% rally pre-market. And options were pricing about a 0.5% move today. So we are already almost all the way up in line with what options were pricing for the entire day. Now we want to keep an eye on this IV. One of the interesting things that happened yesterday was this spike in volatility. So today's IV is 28. That's as high as we've seen in quite some time. Tomorrow's is 17. That includes a PPI number. And then next week we come in a little bit, but this again is a 3-day weekend. You can see this gap on the chart right here. The 3-day weekend. So the vol is really low for that following Tuesday, and that is basically market makers making sure they do not get plugged with premium into a 3-day weekend that decays all weekend and they don't have a chance for any movement in the market. Then you come back out and you can see we're back to like the 13, 12. So most of the volatility really in options is for the next couple of days. We talked about yesterday, if you are looking for hedges, and if those that felt like they missed that opportunity yesterday, as they watched the market tank, particularly in like the Qs or IWM or anything, go back, watch that video, but then go out to some of these March expiries, go out to the end of March, even go April. If you're really near term worried, don't buy options this week. Go out next week or a couple of weeks out and look for puts and put spreads, and that could get you into a place where you can sort of sleep at night, worried about this volatility, holding on to gains that you might have had for last year and into this year. There's some pretty inexpensive, at least vol-wise, hedges out there. And you actually the market is giving you a second chance today if you missed it yesterday, if you felt like you missed it. Now, from a trading perspective, let's just go in. We're using the SPYs. 0.5% expected move. You can see that level is really about 497. We are already above 496 in the morning in the pre-market. The levels, obviously, to keep in mind here are yesterday's lows. And this is going to be about a 2.5% range that we've just seen in the last 24 to 48 hours. So we've got these levels down here at about 491 on the downside. And then, of course, we have just above 500 on the upside. 50, we got as high as 503 and change. So, the levels to watch here are probably, and this expected move is right at yesterday's lows for today on the downside. Of course, we are higher, and it's almost a 50% retracement of this sell-off. But those levels to keep in mind are down here near the 491 level, and then up near the 500, 501 level. And that should be something to keep an eye on especially if you are a credit spread seller over the next couple of days. That high volatility, you're going to be getting some premium, but you might want to go outside of that 0.5% expected move and really remember those levels. A slight bit of volatility that just got injected into the market that is unlikely to suddenly stop on a dime. We saw yesterday, and the ease of which it bounced 1% into the close in the last 15 minutes. Want to look at those very recent levels over the last sort of 48 hours of trading and maybe hit your short strikes towards those types of levels. These kinds of, even with the higher IV, a 0.5% expected move, the market could cut through that like a knife. Now, you might see situations where, let's say, the market found sellers this morning at up a 0.5%, and then it could finish down a 0.5%, and the expected move options will have essentially had it right, but you might see it on both ends of the expected move. And so that's another reason is a lot of times when you're picking strike levels, what you're doing is actually making sure that you don't mess it up, that you don't get challenged, right? Even if something finishes completely out of the money and at max profit, if you were challenged on it like 4 or 5 times that day and potentially taken out on a stop, that's a hard way to trade. If you give yourself enough room where you don't have to panic or take a stop loss or anything like that, that's a better trade, even if it's less premium received a lot of times, because you've sort of priced it in a way where you're far enough away, let's say, that you aren't challenged and you don't have to make a decision at the worst point in the market. I mean, anything that was near to where the spot was trading, that's just triggering stop loss, stop loss, stop loss, stop loss across the board. So when you get these little bits of volatility, look to those levels where you think, yesterday's low is a perfect example. The market would really have to turn ugly for that to break today. And again, for those looking for hedges, suddenly spooked in this market, obviously paying for insurance on a portfolio or against stocks can be very expensive over time. But in these types of moments, where there is a little bit of uncertainty in the market, what you would be looking for is going out, even a month, 3 weeks, a month and a half, 2 months, and looking for those sort of inexpensive things that allows you to sleep at night. And I would suggest going back and watching that video yesterday, because you do sort of get a second chance with this open today.